Yesterday, the euro gained some ground, driven by the news that Europe's economy avoided ending 2023 in a recession. Gross domestic product across the 20 countries that use the euro stagnated in the October to December quarter compared with the previous 3 months, while economists predicted a contraction. Although Germany's output shrank by 0.3% in the fourth quarter, signaling that Europe's biggest economy is on the brink of recession, better than expected growth in Italy and France in the last 3 months of the previous year appears to have helped keep the European economy stable. In addition, consumer confidence in the Eurozone came in at negative 16.1 in January, matching analysts' forecasts. Then, traders shifted their focus to data on consumer confidence in the United States. The index increased in January, allowing the dollar to win back losses against the euro and the British pound. This indicates that the US economy remains resilient even in the face of high interest rates, which in turn supports the greenback. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes a batch of important statistics from the euro area and its member states. German retail sales are estimated to have increased in December. French inflation is expected to be 2.9% in January, down from the same period a year earlier. Besides, Germany is set to release data on unemployment and consumer prices. The German CPI is forecast to decline in January. If data shows easing inflation pressures, the euro will come back under pressure amid rising expectations of interest rate cuts by the European Central Bank. As for statistics from the United States, it's worth paying attention to the ADP National Employment Report. Private payrolls are likely to rise by 145,000 in January compared to 164,000 jobs in December. All eyes will be on the meeting of U.S. Federal Reserve officials. The regulator is widely expected to leave interest rates unchanged at 5.5% and signal the need to stay restrictive to fight inflation. Notably, U.S. inflation accelerated at the end of 2023. That is why experts fear that price pressures could persist. Thus, policymakers are unlikely to mention rate cuts, which will back the dollar up. Powell's hawkish tone could bring the euro and the British pound down, so one should focus on comments by the head of the Fed rather than on the Fed's interest rate decision. And now let's move on to technical analysis. The euro has almost no chance of recovering if the price breaks below 1.0812 and tests it from the bottom up. The market will face a major sell-off, with the euro sliding to 1.0780 and 1.0744 amid Powell's hawkish remarks. At the level of 1.0744, traders may open long positions on a rebound, counting on an intraday correction of 30-35 pips. Going long at 1.0780 will be relevant only in case of a false breakout. Alternatively, if bulls regain control of the market at 1.0812, a buy signal will be generated. However, this scenario is only possible in the event of upbeat data from the euro area and Germany or accelerating inflation in the bloc's member states. Thus, the European currency will rise to 1.0848. If the price breaks through this mark and tests it from the top down, the volume of long positions will increase, with the euro rebounding to 1.0885. At this level, I recommend going short on rebound to catch an intraday correction of 30-35 pips. Short positions at 1.0848 can be considered amid a false breakout. Speaking of the British currency, the lack of important news releases from the UK except for housing prices leaves little potential for the downside. Tomorrow, the Bank of England will hold a policy meeting. The regulator is expected to hold interest rates steady and keep policy tight in the face of high inflation. Therefore, a steep drop in the British pound is unlikely. A false breakout at 1.2659 will create a buy signal. If the price breaks through 1.2693 and tests it from the top down, sterling will advance to 1.2719 and probably 1.2745. Much will depend on Powell's comments. At the level of 1.2745, traders are recommended to go short on a rebound to catch an intraday correction of 20-25 pips. Short positions at 1.2719 and 1.2693 can be opened in the event of a false breakout. Alternatively, if the price breaks below 1.2659 following the Fed meeting, the pound sterling will dip to 1.2627 and even 1.2598. At the mark of 1.2598, it would be a wise decision to go long on a rebound in the hope of a 25-30 pip correction. Interestingly, the lower the British pound, the better the prospects for profits. After all, tomorrow's meeting of the Bank of England is likely to support the pound. Best of luck.